Our next speaker today is Simon Wu, and for those of you who've been to our roadshows, you've heard him speak year in, year out. He's my father, otherwise known as older brother, as he likes to affectionately be known as. Now, Simon has been in the industry for over 30 years. He worked at BT Funds Management. He has worked as a dealer group head and still is a dealer group chairman. He's an accountant, he's a lawyer, he's a financial planner. He holds 4 degrees ranging from accounting, finance, law, and an MBA. He's a radio host. He's head of a accounting discussion group. And that actually doesn't mean too much when it comes to the bottom case. Simon's dream, and now also my dream, is that Australian investors and Australian advisors embrace what we know of Asia that's just 10 hours north of Sydney. We are so close to the region, and later on you'll actually find out that our fund managers that have been in the country now for about 4 days are perplexed to understand why we don't have a higher allocation to Asia, because the rest of the world has. Now, Simon's going to talk about the asset allocation and investment case for Asia, and he's going to describe to you how we do need to take a new look at how we balance out our client portfolios. Simon.
Good afternoon, ladies and gentlemen, and welcome to our roadshow, and thank you for attendance, and welcome to the Year of the Dragon, which you can see. Oh, no. The dragon is here. In the last 40, 50 years, there are 3 dragon years. In each of these dragon years, the Asian market gives you a positive stock market return. And that is a fantastic indication and economic forecast for this year. And I believe that forecast will be as good as any famous economist out in the marketplace. So we're in for a good year in Asia. Now, whether the Year of the Dragon or the Chinese zodiac is going to have the same effect on the rest of the world, let's have a look. I spent 1 minute traveling around the world, and we see some strong indication that most of the indication are telling us the economy in America is recovering. And now, short-term wise, I believe it is pretty good sign. But we all know that in the long term, it's going to be painful when an economy, although as big as in America, have 200% debt over its GDP. Look, it is going to be painful, although I do believe US has a flexible workforce and it's quite resilient. Think about it. They only have 2 weeks annual leave. How many leave do we have? Same cannot be said in Europe. Now, no matter what you call it, long-term refinancing operation, short-term refinancing, cut the BS, it is printing money. They print a lot of euros, 1 trillion of it. So what happened there is injecting morphine into a cancer patient that the pain will ease short-term. But long-term problem has not been resolved. Have you seen the problem being resolved? How Greek is going to resolve themselves? By just borrowing more money? I don't. So we actually believe that there's still further problem ahead. May not be this year, maybe a few years down the track. South America, one of the BRIC economy, Brazil is there, and last year can only give us 3.2% economic growth. Now, I haven't seen one South American fund yet. If there is, maybe there's some opportunity. If we move to Africa, a lot of activity is happening in Africa. A lot of Chinese and Indian money being plowed in, building railroad and digging up mine. But I think the time to invest in Africa probably is not yet. We might wait another 20, 30 years, then it might be a great area to invest. Then come to our beloved country. No matter what you call it your asset class allocation, your term deposit, your fixed income, your equity, your alternative, long short fund, it is all in Australia. Majority of your clients' money and your money are actually in Australia, which consists of around 3% of the world. Great. I mean, we are less than 1% of the population, more than 3% of the economic of the world. We have done great. But is it a wise move going forward? You still believe BHP and Rio Tinto is your exposure in Asia, which is right at the north. Last year, China still coming out with 9.2% economic growth. That beginning of the year, everybody is talking about hard landing, soft landing, mixed landing, whatever you name it. But China been growing at that rate for 30 years, and nobody actually make a comment by the end of the year and say Chinese economy is flying. Have you ever seen that comment on the press? I never. What we are saying is next 10 years got to be the decade of Asia. That is the only area you can find great opportunity because purely of that economic growth. By the way, last year China coming out with the 9.2, average industry company post a 20% of profit growth. Yet, we have this type of share market performance. The market dropped 20%. And across Asia, it's one of the worst performing area. Why? One of the explanation, which our following speaker, Alan, will elaborate, is this risk-on, risk-off thinking of the world's money moving in and out of Asia very rapidly. And another factor is this. The M1 and M2 supply, the monetary supply of China, after the global financial crisis, with $4 trillion RMB in stimulated package inject in the economy, fueled inflation and the property price. What they have done in the last 18 months is actually contracting the money supply, which you can see very clearly. It dropped sharply. And the dark line actually is the Shanghai Composite, which show that very high correlation with the monetary supply. The good news is the inflation is now under control. The monetary supply is already loosened. There's 2 loosening exercises already happened. And we see more easing monetary policies ahead. And also at the same time, the valuation is incredibly cheap that Alan will elaborate. And as a matter of fact, the first 2 months is already giving us some pretty good rebound. And the good news is now we see some nervousness again, and probably is the best time to get in. Now let's go back to the global economy, the contribution from various parts of the world. The 3 largest economic systems in the world, US, Europe, and also Japan only contributing less than 10% of the economic growth of the world. And China alone is going to contributing 40%. In other words, if China contracts that everybody worry about the hard landing story, let's draw all the money and put it under our bed because it will affect everybody. If we love to group the BRIC economies together, you can actually see that the only propelling force actually is China. The next contender is India, still very, very much behind in the green line. And Brazil and Russia actually didn't do much. If we're looking at the Asian economy based on the purchasing power parity, I deliberately put Australia in. It's about 3.3% of the whole Asia. And China alone is 42%. If you take Japan out, which is what we call more mature economy, China is more than half of that. Now, then some of you will say, especially after last year, investing in Asia is too risky. Yes, the short-term volatility is clearly higher. In fact, in the last 10 years, there's 3 crises: the global financial crisis, tech wreck, and also the SARS epidemic. Each time, the Asian market dropped most. So come down to the conclusion, Asian market is too risky. One Nobel Prize economist say, remember this, the economy is the master, the share market is the dog. Regardless how far apart the dog and the master apart, eventually the dog has to follow the master. And this shows if we're talking about long-term investment, which we're always talking the same theory to our clients, that is the only area to give your return to your clients are Asia. Now, some of you would say Asian companies are too small. Are they? The largest bank in this country, Commonwealth Bank, compared with the largest bank in China, by the way, is also the largest bank in the world, ICBC, is about 3 times bigger. And Telstra, our largest telco, is about only 20% of the China mobile. By the way, in China, there's still a few 100 million people hasn't got a mobile phone yet, and most of you have 3. Now, how much more Telstra can grow compared with China Mobile? Hey? Petrol company, Woodside and Petrol China is 8.7 times difference. Everybody will heard of Treasury Wine, $2.6 billion company producing Penfolds Grange, 707, Lindemann, Devil's Lyre, Wolf Blast Black Label. You all know it. Fantastic company. Anybody heard of a company called Yantai Zhengyu Pioneer Wine? Hey? Every day, is it? All I can tell you is that the wine I try that they produce is pretty shitty. It's not good wine at all, but they sell a truckload of it. Last year, they sell $7 billion of wine in China, and they're making $3 billion profit. Look at the balance sheet and profit and statement of the Treasury Wine and see whether they can get that kind of return. In mature market, give you great opportunity. And finally, we all know Harvey Norman, Gourmet Electronics, just the same operation, similar operation, 2.3 times. Finally, I leave this chart to you. 8 years ago, US equity market is about half of the world. Today, shrink to 1/3. Greater China consists of Taiwan, Hong Kong, China, is about 5% only 8 years ago. Today, 13%. Ask yourself a question. Next 10 years, which portion of this pie chart will grow faster and which portion will contract more? How should you allocate your assets and your client's assets according to the trend that you believe and yet has not been followed in the last 8 years? I leave that to you. Thank you very much.